Without further ado, please allow me to introduce my panel of esteemed brokers. Stacey Parker is a senior claims leader at Aon with more than 25 years of experience advising global organizations and their executives on complex and high-severity financial lines claims, including D&O, EPL, crime, fiduciary, cyber, and professional liability and E&O. A respected leader within Aon and the broader industry. Stacey serves on multiple firm-wide claims and inclusion councils and has been recognized as an Insurance Business America elite woman. And I had the privilege of working with Stacey on some of the most difficult claims of my career, and I am very privileged to consider her a partner and a friend. David Henson specializes in D&O at McGill & Partners and has more than 8 years of experience in the financial lines brokerage industry. With a proven track record of helping clients navigate complex financial lines exposures, David is responsible for elevating client understanding of financial lines coverage, developing tailored insurance program strategies, and ensuring seamless implementation. And finally, Chris Scott is a Senior Vice President for Financial Institution Clients of Marsh's Financial and Professional Liability Practice. Chris is responsible for account placements and advisory services, helping clients to build customized solutions to best address risk management needs and potential program coverage gaps. Thank you so much, everybody, for being here. So I think let's start out talking about the market. February and March is a very busy time for my clients, and I'm sure yours, many of whom are in the process of negotiating and finalizing their renewals right now, binding coverage, reviewing programs, and generally trying to assess what the market is going to look like in 2026 and going forward. So, let's talk about what your clients are seeing in terms of the 2026 market and what you are advising them about. Chris, can we jump off with you?
Yeah, absolutely. Thank you, Diana, for the intro, and nice to see everybody, meet everybody. In terms of the marketplace right now, it's kind of the golden question, the D&O marketplace at any point, right? Where are we at now? Where are we going? And it's important to also see or talk about where we've been, right? Where did we come from? The D&O marketplace is pretty cyclical, and we often cycle through what we call hard markets and soft markets. I'll use the analogy of a roller coaster because I think it works, and it also kind of feels like we are in a roller coaster at points in the insurance marketplace. But the hard market is kind of at the peak, right, at the top of the roller coaster, where insurance rates are high, not favorable to buyers, and it feels like you're spending a ton of money for coverage, right? And that is often led to by contraction in the marketplace in terms of capacity, increasing claims, and increasing rates. That get us to that top point, and then you go down to the bottom, which is considered a soft market. And the soft market is favorable to buyers. Insurance rates are lower. Oftentimes, either there's a lighter amount of claims, and/or claims just aren't costing as much. And usually, there's an abundance or a decent amount of capacity and competition in the marketplace, which allows to capitalize on those low rates. So, to simply put where we're at right now, I would say we are on the softer side of a stable marketplace. The past few years, we saw a very soft marketplace for D&O coverage. Rates were very competitive, especially on kind of the heels of COVID, where we saw the hard market. The claims activity was lighter over the past few years, and our clients and insurance buyers were really benefiting from an abundance of capacity and competition in the marketplace and very low rates. Why I say we are kind of on the soft side of a stable market now is we have started to see rates creep back up a little bit bit towards what we would say flat, in that range of flat renewals year over year, not too much change in pricing for the most part, maybe a point or two, give or take, either side decrease or increase. But ultimately, in the soft market, insurers were basically saying that rates were approaching their minimum premiums on their book. They did not see profitability on their book, and it just wasn't sustainable for the long run. So some of them started to dig their heels in a little bit to push back on rates, to try to keep things flat. We have seen an uptick in claims activity in terms of just the quantity of claims coming in, the increasing of the cost of claims. So all that has started to creep back up towards not necessarily increasing rates, but again, kind of flat and stable year over year rather than the big decreases that we saw. Yeah, I think that's for the most part. Again, one more note. I think decreases are still available. We still see them to some extent, but it has moved towards the companies that have clean loss history and that are deemed to be exceptional risks in the market, and everyone else, again, as the most part, is generally flat.
Yeah, I would echo that. I think every insurer would tell you that what they're hoping for in the D&O marketplace in 2026 is stability, which for them means flat rates. They're not looking to push for large increases in most cases, looking to change retention. They just want stability on their renewal book, and they want to stop giving money back, especially in the excess layers of programs. I think what we've seen or started to see is that some of the excess insurers are drawing a line in the sand and saying, we're at our minimum premium, we can't go down any further. So even in cases where you might be able to get 5 points off the primary versus excess, we're starting to see pushback in those higher excess layers in continuing to further decrease the price. I think where Chris said we're kind of at the bottom of the roller coaster, I do think we are starting to move, or starting to see signs that the market is hardening slightly. I think the first thing that we usually see is that capacity starts to be constrained, and whether that's large insurers cutting their primary capacity from 15s down to 10s, insurers cutting from 10s to 5s, or insurers exiting the public D&O marketplace altogether, which we've started to see recently. Those are all signs that their profitability is starting to struggle and that they are reevaluating their portfolio. So we, in 2025, saw Markel exit the public D&O marketplace, Argo exited the public D&O marketplace, and then most recently, Everest announced that they were selling their renewal rights to AIG, and then a little bit different of a situation, but Zurich and Beasley are also planning to merge. So all of those point to me that we're heading in a bit more of a harder market direction. I think that 2026, the majority of insurers will have no trouble renewing their program flat or even maybe at a slight decrease, but I do think that there are some signs that we may start to move into a harder market here soon.
Hi. Thank you, Diana, for your lovely comments. I feel the same about you. Hi, everybody. Nice to be here again. Stacey Parker from Aon. I just wanted to add to your perspective. Of course, I'm going to be in the lane of claims, right? So very claim-centric, very policyholder, advocate-focused. And I would say when we're talking about placement and market and capacity, one of the most important things that I like to talk to clients about is really claims, the claims department. Who are you getting into business with, right, on the other end? I feel like the claims department is really the operation, the operating system of the D&O product. It's promised to pay. And so the most important piece of it, I think, not only is just consolidation and price, because I think sometimes when our risk managers or our clients chase price, they may sacrifice claim quality. And so I think the important issue is who do you want sitting across the table from you when you're negotiating that hard claim that we were trying to, sit through in the last presentation. Who are those people? What are their reputations? Have they actually paid claims? Have you checked that out? And those are the types of things that I think are as important, or even more important than price, capacity, and consolidation in the industry.
And just the last thing I would add about the state of the market is that, as I said, insurers are really focused on maintaining their renewal premium. And so there may be ways that you can enhance your coverage within that primary form in order to allow them to go flat. So instead of pushing for a 5% decrease, maybe you can go flat and get them to throw in enhancements, whether that's increasing the derivative demand sublimits or providing some level of entity investigation coverage, things of that nature. I think it's an opportunity when you are in a stable market like this to push the coverage and make sure that you are still enhancing that policy so that it responds the way you want to. And on that point, some people in this room may have gone through this recently, but there are a number of new coverage forms in the market. So Zurich, AIG, Chubb, all of which are large primary D&O writers, have all released a new policy form, and then Beasley has released one recently as well. The one thing I would note with that is that I would encourage you to take time, or have your broker take the time to actually go through and analyze how your coverage is changing year over year. The insurer will most likely provide you with a sell sheet that will talk about the enhancements in the form and why they believe it's a simpler coverage solution, but really making sure that you understand what's in that new policy that you're buying is really important.
Yeah, thank you for raising that, because actually I do have a number of clients who have called and said, AIG's primary, they sent me spec, and it's different from what I've been doing for years and years, likewise Zurich. I'm just curious, has anyone had the opportunity to look, are there any new exclusions or endorsements that policyholders should be aware of, or is it really just, essentially the same coverage, maybe phrased in a different way? Anything snuck in there that we should know about?
I would say looking at the bump up exclusion is important. That language we have found in, I think it was Chubb's newer form, was a little bit less advantageous than AIG's, for example. But generally, the reason for these new forms is to try and simplify them. If any of you have an AIG primary, on their old form, you may have 100 endorsements on there, and some of them may be changing the exact same section of the policy, and so it can create some ambiguity. Their goal with these new policy forms is to bake some of that endorsement language that they're willing to give to every D&O insured into the base policy form and make it simpler for their adjusters to evaluate claims.
And also, if you work with your broker, a lot of the brokers have, a mandatory,
Yep.
So there are specific asks that new broker may consolidate on behalf of their clients and go to the markets and use the leverage and try to get those endorsements for that particular broker or those particular markets move forward. So those are really, really helpful coverages, not necessarily only new coverages, but really looking at some of the coverages that are there. And as we know, one word can make all the difference between coverage and no coverage, or a broad preamble and retirement exclusion.
Or a comma, who knows?
Sorry. And I was just going to add on a general note with all that being said, I think, it's a lot of us will be purchasing policies that have 100 endorsements, right? That's the state of where the insurance market is, or the insurance industry as a whole, just kind of archaic to an extent, right? But it's very important on a general note, when you are changing forms, very important to review the form and make sure your coverage specifically is carrying over, right? And don't be afraid to ask underwriters, insurers to provide an overview on what the forms are changing, right? Even ask for a red line if possible, so you can see the changes. Because at the end of the day, and I think it leads into kind of what we've alluded to before in partnering with the right insurers and make sure they are on the same page as you and they're not trying to pull a fast one over you on coverage that may be lost or whatever. Ask them, they're doing the work to change these forms, ask them to provide the information that you're looking for. And then obviously you have to do your own review as well. So I think that's just an important piece. It's as the form changes are typically beneficial. To David's point, they are trying to streamline, which is great, but a lot of these insurance policies are very customized to the buyer, so you just want to make sure nothing is being lost in that transition. And Diana, on your point with endorsements or exclusions, one thing I would note is the cyber exclusion, which we are seeing now across the board on not just D&O policies, but basically most policies other than cyber liability. And the point or the intention behind that is cyber is now, I won't say necessarily a mature product yet, but it's a growing product. It's been around for a while. Insurers do not want any gray area on what they would call silent cyber, or any questions about cyber liabilities being picked up on other policies. So we are seeing affirmative exclusions on D&O, professional liability, and other crime, basically to make sure that cyber is bucketed on those cyber policies.
Even if it's an SEC violation or a securities class action lawsuit, or just, first party issues regarding cyber.
Yeah, it's first party issue. No, you can't put it, that's the bread and butter of the garbage under the D&O.
I was going to say.
We don't have any exclusions like that. Yeah, fire your broker if you have those.
And even on the private company side, where you may see that cyber exclusion, you should be able to negotiate a carve back for
Correct.
any side A claim that resulted from the cyber breach.
All right, thank you. So, having addressed the market, and of course, the marketplace and the availability of coverage is going to be, part and parcel probably of everything we talk about. As we all know, and as Stacey referenced, this is a product that responds to claims, and claims ultimately drive the market. And so I'd like to discuss what you and your clients are seeing in terms of the claims that are coming in, the claims that are perhaps diminishing, we're wrapping up, and what you foresee as being the most relevant issues that clients and insurance companies are going to be addressing in the 2026 claims environment. Stacey, do you want to kick us off?
Sure. I have a lot to say, so you're going to have to kind of pull the microphone away from me. But first I want to just start with kind of the heightened exposures for directors and officers or clients facing this. I think that the accountability for directors and officers has really intensified. There's exposure in a lot of different areas, and I would kind of describe it as a web of kind of intersecting trends that are happening at the same time. You may have, kind of the macroeconomic, right, and then you would have like geopolitical instability. You may have technological advances like moving at the speed of light, all that, and you have active kind of litigation, mature litigation environment and regulatory environment, and then you certainly have, the onslaught of cyber and AI and increased bankruptcies and insolvencies and some of the ESG, fallout. It's really more complex, I think, than it ever has been, risk and, navigating risk within a company. So I just kind of wanted to mention that I think the boards or clients are really facing the toughest kind of disclosure obligations, and they really have to be ready for that challenge. So what does it look like when perhaps they get it wrong, right? Then you're talking about frequency and severity. I don't get too caught up in the numbers, whether we're ending up a little bit or down a little bit. I think, we talked about that a little bit. And I think one of the most important points when we talk about frequency and severity is that there's a lot of stuff still in the system, right? COVID happened, they suppressed the claims, they came out after COVID. All that we have to get through yet. So even if we're taking down, we're talking about a long tail product, so there are years. So it's new claims and old claims, and obviously that's going to impact how placement and capacity and markets are running. So with respect to frequency is around what it is. Severity, I think, is heightened, and the reason why, I think, is a couple different. One is this whole issue of social and severity inflation, and that's really how people think about who should be responsible for harm, and you see that with the nuclear jury, the thermal nuclear, I don't know what the word du jour is for it, but really, really high, 100 million and more. And it's interesting when I talk about, we have a mediator in the room, when I talk to clients and we're going to mediations, plaintiffs are starting with the B, not the M, right? $1 billion settlement valuations, maybe based upon market capitalizations for companies that are so much higher than they've ever been, especially, in the tech sector. So social inflation and all the defense costs, specialized counsel, all the social inflation of trying to get those rates approved and how they're going to be absorbed into these products. And then we have the SEC and the DOJ. And I think with the SEC and the DOJ, what I've seen from my claims kind of optics is that there's many more parallel proceedings, either amongst and between the SEC and DOJ, where they're working together more across borders, using data analytics innovatively, trying to figure out how to get cooperation from clients, or one maybe hangs back and the other comes forward, leveraging whistleblowers. And also, we talked about in the last panel, all this kind of layered with the fact that there's a lot more parallel proceedings, not even just with regulators, tag on derivatives, or derivatives leading and securities class actions coming, or you have an investigation that leads to a securities class action that leads to a derivative, or demand and then a derivative. So all that, I think the frequency and severity is there. I would say, I talked about social inflation, I would say that another piece of it is litigation funding. I think once you have third-party funders that are, hedging a bet on litigation, it ups the price of poker. And I think that they may be more aggressive. There's somebody behind the lawsuit that has, a business kind of modeling, and that may impact what, clients are paying or faced with respect to settlement demands. So those are some of the issues, I think, kind of layered like an onion that I would reference on trends.
Yeah, I think that's, you hit it perfectly. I think just to check in on the social inflation and the increased cost of claims real quick, I think you hit it perfectly from the claim side, and then just from, I'll say, the underwriting side of the house, if you will. A lot of the messaging that we're getting as brokers from our insuring partners is the cost of claims have increased significantly, and now, let's just look at an insurer that used to participate on a D&O program attaching at, excess of $50 million on limit. All of a sudden, they are looking at that risk as, what's considered the burn letter, right? These defense costs themselves are going to have increased, and now the potential of these higher excess and attachment points are now jeopardized just as much as the lower excess letters. So what we're hearing from the underwriters is, we feel like we're just as much at risk for paying a loss attaching at 50 as those attaching at 20, and therefore we do want to get paid more for our capacity where we are, or we want to try to get down on those lower excess layers to collect the same premium for the same amount of loss, or the same risk of loss, if you will. So I think that's a great point. And then just to reiterate the long tail nature of this product, and I think that's a lot of Markel specifically, as David mentioned, they were experiencing losses that happened a few years ago, and given where the rates are now, they didn't see necessarily a way back to profitability on their book, and so it's these claims that are coming from COVID, that are coming from the Me Too movement, and coming from these kind of historical trends, if you will, that are now hitting the books currently. So we're seeing a lot of that have an impact as well.
And just a note from what you said, when those excess layers are on a claim, especially a securities class action, unfortunately, you're right, nobody is safe, right? So even though they want to take their pound of flesh on the next renewal, what happens during a claim, as we know, they want to be much more involved.
Yeah.
Everybody, getting requests from the 5th layer access and the 7th layer access, for liability damage, and all of a sudden they want to look at all the defense bills and determine whether or not it really, that they really had exhausted the retention appropriately. Those are some difficult conversations with excess carriers.
Yeah. So at the end of last year, and actually probably even earlier than that, there was a lot of speculation that the DOJ and the SEC might be ramping down compared to what those organizations had been doing previously. And in fact, at one point there was a brief moratorium on FCPA investigations. have we seen that in practice, or in fact, are those agencies, continuing to, ramp up investigations that are affecting companies, directors, and officers?
I can speak to that for a minute or two. I think people felt that in the new administration, perhaps, and if you look at some of the comments that SEC Chair Paul Atkins has made, he was saying that he thought that the, American corporation was overburdened with disclosure obligations, and so therefore he's, thought that we should, have many more reforms, and so people thought that that was going to lend itself to a pause, on that, and I think in what we're seeing, I think it just was a pivot. Maybe not this case, but this case, right? So I have seen the DOJ and the SEC both very active and very in line with one another, which I hadn't seen that before, not only in tandem, but working actively together, sharing information both on the criminal side and the civil side. So that I think I hadn't seen. That's worse and not better, right? Because if they're working together to bring that information, it could be, worse for policyholders that gets in the crosshairs of that. And we know how that is. So.
Thank you. So it's been a little bumpy and chaotic in that arena, and anybody who has a newspaper or a phone knows that in terms of the geopolitical climate right now, it is also a chaotic time to be living on this planet. And of course, as we know, geopolitical trends as well as the related macroeconomics very much affect the claim sphere, particularly when it comes to the types of claims that D&O might cover. So I would like to touch on that a little bit. David, do you want to maybe take a stab at addressing how this climate is affecting the claims landscape?
Yeah, absolutely. I think with everything going on macroeconomically as well as just with geopolitical tension, it's obviously a difficult time to be a director or officer and to be able to make decisions that will be to the benefit of the company without knowing exactly what's around the corner with respect to inflation or tariffs or things like that. I think from an underwriter standpoint, what they're concerned about when they're thinking about a D&O risk is just the disclosures that you are releasing publicly as well as the risk factors that you're identifying in your 10K. And particular to these issues, are you contemplating how geopolitical unrest in the Middle East could impact your business, and are you disclosing how that could impact your business? And unfortunately, it's tough to know exactly how it could impact your business, but I think the important thing is that these are board level issues that the board is talking about and is thinking about before you're making any types of disclosures about your expectations for the year or things of that nature. And then I would say just in general, kind of on that topic, we are still seeing more D&O claims that we would say arise from events versus a typical restatement. It started, I would say, with the Me Too movement. We saw some D&O claims arise out of that, and then has led to cyber breaches, environmental events, things like that we're now seeing lead to D&O claims. And I think that still is occurring, particularly on the cyber breach side, making sure that the board is in those conversations about cybersecurity and aware of the potential issues if you did have a severe disruption or breach. And then on the topic of AI, that is something that D&O underwriters are also talking about, and it is a trend that we're seeing on the claim side. I think there was 17 that were logged as AI-related securities claims in 2025. And a lot of that is also related to disclosure. So whether it's disclosing the information that you're using within those AI tools or disclosing how it's going to impact your bottom line, any type of projections about how AI is going to impact your business is going to be scrutinized by the underwriters. And that is definitely a top conversation that across all industries is being addressed.
I'd just like to add a couple of comments. Look, if you're a company that is, has a lot of foreign employees or employees that have visas or dealing with immigration, this is a tough time. If you're a company that has dealt with tariffs, I mean, that too, these are tough issues. We just had a decision rendered by the U.S. Supreme Court on tariffs, where they said that the current administration has exceeded their authority, and so now there's a ton of these tariff refund suits being filed by companies, FedEx and Costco and whatever. Those are tough issues. How do you quantify for what year and what, those are tough. I do think that those are going to bleed into D&O issues, and as you said, I think a lot more is, event driven, so it's like the gift that keeps on giving. It's the one event, and then it just spirals out to so many different layers of litigation that are now boardroom issues affecting our clients, the directors and officers.
Yeah. Yes.
Quick question. Recently, you probably saw that various sectors in the market have been decimated. Software companies, insurance brokers, you name it. It's just it goes on like a carousel. One day it's one sector getting decimated, another day it's another sector getting decimated because of the coming of AI and the challenge to these companies and industries because of AI. If all these shares are down 10, 15, big names, 20, 30%, is there any defense that nobody else thought it was a threat? So why are you picking on us? It's like telling a cop that everybody else is speeding, why he's stopping me? So if somebody says to a certain software company, your stock is down 30, 35, 40% because you never saw the coming threat of AI, is there any defense that the entire sector got decimated?
I mean, I'm a lawyer by background. You have to ask, one of the defense or the plaintiff's lawyers. But Bill, you can answer. But I would say yes. If it's generalized.
See that the room's not here. If your room were here, he would say, as a plaintiff's lawyer, that's not the case you want to take. Because the case he wants to take is the case where there's a stock drop without the market movement,
right,
which implies that there was some problem with management, as opposed to there being a problem with the market.
But basically, the threat is
what all the analysts are saying, and what the threat is, that none of these geniuses should have seen this coming. They should have seen it coming, and they didn't. So the fact that one is as dumb as the other, where does that all play out? Because you can pick out one and say, didn't you see that your company, your business model, would be threatened by AI? And they would say, gee, I guess so. So there you got one company. Is a defense that hear no evil, see no evil, and they point to all the other companies. And you can point out that they were not that bright to realize that AI could be coming for them.
And unfortunately, anybody can file a suit about anything. And so the D&O product, if it gets the suit, right, you would have to determine whether or not there's, defense costs that would be paid. And hopefully, if that's the case, that the whole industry should have known and it's not a specific issue.
Pick one company. What is it?
Yeah.
Just pick one company.
Yeah, but if it is specifically one company and it's only akin to that company, maybe you would, have defenses and have to determine whether or not, it's a case to prepare for a motion to dismiss.
And of course, all of these complex issues, what I think we're also seeing is increased bankruptcy as a result. And how is that going to play into market?
Yeah, definitely. I think I saw there's been 5 straight years now of rising bankruptcies, and they're expecting 2026 to be a higher year as well. I think bankruptcy becomes a D&O issue the majority of the time, I would say. And a lot of times when you start to consider what's actually in your D&O policy is when you're already in that zone of insolvency or maybe preparing to file. So getting your broker involved as early as possible in those situations is very important because they will want to negotiate runoff coverage that oftentimes the company is going to want to pay for before they even actually file for bankruptcy. So getting your broker involved as early as possible if there is that type of situation is really important. I I can't remember what my next point was. So
I was just going to make one comment about bankruptcy. I agree with you. We have a lot of clients. It's a very complex issue. Filing bankruptcy, one thing, right? Bankruptcy in and of itself isn't a claim, right? But there may be other claims in the vicinity of a bankruptcy that you want to be looking at and talking to your clients about, whether they're employees leaving or you're stop paying the pension or, something else that's impacting, or there are creditors filing suit or something, or you're closing stores and you're letting employees go. So these are all the different issues, and sometimes, in our role as brokers, we will help kind of guide the client because they're so focused on the filing of the bankruptcy and trying to get that runoff place that they may not think about that there are other kind of implications of the bankruptcy with respect to circumstances or claims. Because when you go into a runoff policy, that then, changes the scope of the policy.
And the one other point I was going to make is just that Side A insurance becomes extremely important in a bankruptcy scenario. So even I've seen issues even within a client put their ABC D&O policy into runoff. It was a private company. They had a major shareholder exclusion on that policy, and so that even applied to the Side A insuring agreement. And so when the creditors committee brought a claim against the directors and officers, it was excluded by that major shareholder exclusion. So making sure you have a Side A DIC policy on top of your ABC tower is extremely important because that policy will have less exclusions and will typically be able to drop down and provide that personal asset protection when you need it.
Part of it was the Side A, so thank you. But when you were mentioning before things like COVID and cyber and Me Too, what we've seen is that those claims come in two ways. One where the directors are named in the original, let's say, cyber suit or EPL suit, but sometimes they're not until later, like they settle the EPL class action. And then the stock drops when that goes in the news. And then there's a new case for them making this big settlement or not settling sooner or just allowing that conduct to go on. And the same thing with cyber, where it comes out later. Are you seeing that now, like some of the follow-up cases that way?
I have actually seen several of those where the company settled some suit, an underlying suit, and then it was announced, just as you said, and then, people are reading it in the news, it's in the news, and then the stock is dropping, and then there's another lawsuit, or it's in their 10K or their 10Q, or they're putting it out there in public statements, and then shareholders, see a stock decline, why did you pay, or if it's connected to something in the news, like Jeffrey Epstein, if there's ding, if there's a name, or if there's something, Harvey Weinstein, whatever the name du jour of the things that we're facing now. And so when that happens, we do see some traction on claims from those. Yeah, absolutely.
It's 2026, and we have hit upon tariffs, AI, Weinstein and Epstein. So I feel we're very topical. We've hit all the buzzwords, which is great. We could talk about the claims environment for another hour, but then we put it to Bill's time. So instead, to wrap up, I'm just going to ask each of our panelists to wrap up by sharing your thought, your advice, your prediction, whatever it is that you would like your clients and the D&O world at large to know based on your expertise and experience. Chris, let's start with you.
Thank you. Yeah, my advice, and what I try to message to clients is relationships are very important, and insurance is expensive, and you want to be able to utilize the insurance that you're paying for. And part of the way to do that is to partner with the right insurers that help you build a stable program, right? Not for now, but for years to come. I think things we've talked about, the claims activity, the claims teams at insurers, David's point about coverage, all of these things or these other areas that come along with insurance are, there are other pieces of the puzzle in complementing pricing, right? Pricing is not always the driver. Obviously, it's a very big consideration, but if you are focused on partnering with the right insurers that have solid claims teams that can help you either defend cases or maximize your product and pay the claims, that's huge. If you have coverage is a huge thing, right? If you are paying for policies that are skeleton in terms of what they provide for coverage and they don't respond to any lawsuits or claims, then you're paying for nothing, right? You lose the value. So my point being is relationships are important. Focus on these other pieces as well, which will also help kind of mitigate the changes in the market, right? It helps to mitigate the swings from high to low and can provide some more consistent pricing, consistent programs year over year, as opposed to being variable with the swings in the market and the economy.
Yeah, I would echo that. I think in a stable marketplace, it would be an easy year, and it probably was an easy year the last few years for risk managers or treasurers, whoever's responsible for buying this product, to just roll it over and have the same policy form, work with the same insurers. I think it's an opportunity, though, to really push the coverage within that form, as well as to ensure that you're working with partners that will be there in the event of paying a claim or that you have good relationships with. So to Chris's point, I think relationships go a really long way in this industry, and especially on the primary or your first few excess layers that will be involved in the event that you do one day have a claim, making sure that you know the underwriter, you know the claims people on the other side, you've met them in person before, you've spent the time to invest in that relationship over time. I think it really goes a long way, and I think our clients who have done that over the course of the past 10, 15 years did see the benefit of that as we went through the last hard market cycle. So as we head into as we're starting to see signs that the insurance market might be starting to harden a little bit more, I think it's an opportunity to really focus on building out those relationships with your key partners, as well as making sure that the coverage is best in class.
I agree with the relationship piece, but I wanted to focus really on two pieces, more practical advice. So we have all these great relationships, we have the best wording, we have process in place with the insurance company, the best claims team. But what I think we should be working on more is the client, right? So 2 points with that. I think the client and the organization really need to truly understand what amazing great coverage they have, right? And understand what they purchased, because sometimes the purchaser and the user of the insurance, there's a disconnect. Who's purchasing it may not be using it, and who's using it may not have been involved in purchase. So I think that there's an alignment and an education that we need to happen to help with. The brokers and the risk advisors and coverage counsel can help educating and connecting the dots within the companies to legal and treasury and risk management and whoever else is involved in the claim. That's step one. Now, why is that important, right? So we always say the time to fix the roof is not, when it's not when it's raining, it's when the sun is shining. So when you have a claim, it's not the time to call and say, oh my God, is this covered? What do we do? Because hopefully we've been through the drills and we've been through the exercises of understanding how the program is built out, who the claims team is, what coverages you have. Because we find that sometimes in a claim, treasury, risk management, and legal, they've never worked together. They sometimes don't even know who each other is, and so sometimes the broker has to get involved and kind of fill in the gaps on that.
I've got a question about that process.
Sure.
I remember years ago it was a style at that phase to introduce the client users to the claims team. Is that something that's still happening today?
I hope so, yes.
Great idea.
Yes, and that's what we strive to do, but it depends on an interest level, and it depends on who we get, decision makers at a table, but yes, we try to have that.